So today we're going to talk about the sort of historic levels of the stock market and what it means for sort of the macro giving sector, and then also what it means for you and your job. Quick note before we get rolling, this is approved for 1.0 CFRE credits. Thank you, Simone, for doing the legwork to make this possible for everybody. We know that some professional development budgets have been suspended, so I'm really, really glad we can do this for you. Basically, the way CFRE works, and many of you know this, so excuse me, is that you keep your own records. So you don't have to email us and say, can I get my certificate or anything else? But on occasion, CFRE audits people, and then they need to show proof that they've been there. So we have a survey at the end. We'll make a note of everyone who's here. We're not going to sort of send you any receipts, but if CFRE comes knocking, then we'll help you out and make sure you get credit for that. So that's how that works. Today's agenda, we'll do some very quick introductions. We'll talk about how your week is going. We'll talk about understanding the stock market and actually why it's getting bigger and what happens historically here. We'll talk about the effect this has on giving at a macro level. And then we'll break into some strategies and tactics for actual success, making the most of this moment compared to, say, last year or the year before. We'll talk about how stocks are having an effect on QCDs, what are called qualified charitable distributions, this sort of massive growing area, especially among older Americans, and what it actually means for planned giving. A lot of people don't think about stock market and planned giving at the same time, but they're actually really tightly correlated, and there's some interesting things there. And then we'll just do some next steps in Q&A. So settle in. Definitely less than an hour, maybe a little bit shorter than that, but we do have a lot to cover, so I'm going to go through it relatively quickly. We'll send you the recording. We'll send you the slides afterwards, so don't sit here and sort of furiously take notes if you don't need to, but if it helps you remember some things, no problem at all. Quick intro. So my name is Patrick. I know a lot of you guys. I'm really excited to be here along with my co-founder, Jenny Schaus-Bradling, who is just the best. And then we get to work alongside about 90 folks now and raised about $2.6 billion so far in terms of new bequests and stock giving, QCD, some other stuff. So a lot of the research and work you'll see is not mine. It's from all these amazing folks, and wanted to give credit where credit is due. Also, really appreciate you guys making the time. And so when we think about sort of understanding the macro trends and what that looks like, we did want to give away one of my favorite books, which is something called Thinking Fast and Slow. It's by an economist named Daniel Kahneman, who also happened to win the Nobel Prize at some point recently. So this guy is not dumb. As a quick aside, I read this 2 weeks ago, meaning not the book, but this article, that this book is taking over baseball, that a lot of the general managers and managers are using this to change the way they're thinking about strategy. So it's a great book about sort of strategy in all of your work, regardless of field. We'll send a survey around at the end and just make a note and add your address and things like that. And then we'll ship it to you. So we'll give this away to 20 folks, and don't put it in the chat now. Sometimes that happens. Just put it in the survey a little bit later. So hopefully you'll love that. It's a really, really smart book. Okay, so we asked how your week is going, and look at this blue line. This is the happiness line. We've tracked this for exactly a year. So you can see about March 13th is our first session. That was, as many remember, sort of the beginning of pandemic. We're a year into some form of lockdown in some parts of the country. So fascinating to see this happiness go up over time and dramatically higher than it's ever been. This yellow is anxiety, also the lowest it's been in all of our survey. I mean, some of this has to do with hopefully good weather, but certainly things like lowering cases and increasing vaccines and everything. So really nice. Also, look at this loneliness curve, which is the lowest it's been as well. So pretty exciting to see there. We also asked what folks are worried about, and there's some less good news here. You can see a lot of the health and safety, which is sort of the red line, the yellow line, that's trending down. But this blue line, which is how am I going to hit my goals this year, is going up. And it's almost as high as it was in July, which was a really tough period for a lot of folks. And part of this is just, hey, there's so much changing. What are we going to do differently? And as much uncertainty as there was in 2020 going into this, there's a lot of uncertainty coming out of this in 2021. So hopefully we can be pretty helpful here. All right, let's dive in. So we're here to talk about what's happening in the stock market. What does it mean for giving overall? What does it mean for major giving? What does it mean for planned giving? And let's dive in. We first asked you, how comfortable are you with stock gifts and sort of giving around here? And so we saw some pretty variant answers. So on a scale of 1 to 5, here's where you said 16% said 1, not confident at all. Only 10% said 5, very confident. And the average was about a 2.9. So if you think about 3 is actually the median here because there's no 0. So everyone's a little bit below average in terms of how confident we're feeling. And that's okay. This is not unusual or unexpected for someone in your role. There's some confusing stuff here, but hopefully we'll make it really easy today. We also asked you, when you think about stock gifts and how the stock market affects giving, what do you think about? What does this come to you? And you can see this massive sense of opportunity and potential. Smart is a really big one, right? It's sort of savvy and smart is one of the smarter ways to give. But also you see at the bottom here, confused. Sometimes potential means also, hey, I think this could be really bigger, but it's not. You see underutilized there, unclear. It can be painful. So a lot of stuff there, and we'll dive into it a bit more as well. But let's sort of start at the very beginning. And we'll do this quickly because I know some of you know this like the back of your hand. But for many people, it's actually worth a quick refresher here. So what is a stock at all? A stock is a type of investment. It represents an ownership share in a company. So if you own one stock of Google, you own a very, very small amount, but you own the company Google. Investors buy stocks for the most part that they think will go up in value over time. Sometimes you might buy something that is going to hold tight and produce dividends, but that's sort of a different story. We won't focus on that much. And there are a couple of different types of stock. So the most common that you think about when you think about a stock, you think about what's called a publicly traded stock. These are sold on stock exchanges. You can buy and sell it at any point. Pretty simple. And many of the big companies that you think about will have publicly traded stock. Now, secondly is what we call mutual funds or index funds or ETFs. ETFs are exchange traded funds, but people just call them ETFs. And this is sort of a group of stocks versus a single stock. And so this way, mutual funds are really generally a good idea because they actually go up and down the way a single stock would, but for the most part, they're less variant. And so one individual stock is really risky. What if the CEO has a really bad month? What if something happens to that particular industry? But generally, the market overall tends to go up over time. So a lot of people choose to safely bet in index funds and ETFs. And then there's this third category that we don't think about as much, but is also really true, is what are called privately held assets, stocks in a company that is not a publicly traded stock, that is not on the exchange. And so something like Instacart, which many of you have heard about, certainly Uber until a couple of years ago, Airbnb until a couple of years ago, these are stocks where you still own a part of that company, but actually you can't buy it and sell it freely. And some of these will be really, really big. Some of these might be like a share in Joe's Plumbing, where it will probably never be listed on the NASDAQ, but actually that share of that company is worth something and has value. And then when we think about how did we get here? Well, sometimes we just, these things tend to be, but certainly in one case there were not stock exchanges and there was not stocks. And so what is the actual origin of this? Well, there's I don't know if anyone knows what this picture on the left represents. Feel free to type it into the chat. But the first modern stock exchange was actually created in Amsterdam in 1611. I'll give you guys 3 seconds to guess about the picture and then I'll just name it. See if we have any guesses. Yeah, Juliana's right. So tulips, good one on tulips. So the Dutch East India Company, this is the first company, obviously created in the Netherlands, to ever sell shares of stock. It was a huge innovation. And this is a big exploration company. At one point, by the way, the Dutch East India Company was worth about $70 trillion in today's dollars. So worth more than Apple, Facebook, Google, et cetera, all combined by a factor of like 7. I mean, just an enormous, enormous company. And people made fortunes. And there was a note here by Maritza about tulips. And at one point there was this tulip craze in Amsterdam, and the Dutch East India Company made just a killing on it. They also, by the way, as some folks noted, did some pretty nefarious things along the way. So we're not celebrating them, but it's sort of a noteworthy thing in history. In 1790, the first American stock exchange is formed in Philadelphia. Later, New York becomes the central component of the stock exchange. Those of you who watched Hamilton will sort of remember some of the role that the banking center and Alexander Hamilton played in setting up some of the New York stock exchanges. In 1896, the Dow Jones Industrial Average. For a long time, Dow Jones was sort of the primary marker of how well the stock market was doing. In 1923, the first version of the S&P 500 is formed. Now, both the Dow Jones and the S&P are just a collection of companies that they're tracking together to say, okay, well, how well is the market doing rather than how well is Ford doing, which will have some up and downs. And then in 1929, the US stock market crashes. It's one of the first big crashes in American history, at least, around the stock market, and dropped sort of tremendous amount. Small side here, my grandmother was actually born on the day the stock market crashed. And so it was always fascinating to hear about how her family was pretty middle class the day before she was born, and then immediately lower class the day she was born, and how that actually affected a pretty tremendous number of American families. And this sort of abstract concept of the stock market crashing. And because it was both in a moment of lower familiarity with stocks, it just had this sort of wild shifts and really affected a lot of families in a pretty negative way. It took us a long time to get out of the Great Depression. And so in 1971, jumping ahead, you start to see this other big shift where NASDAQ is formed. NASDAQ is the third index to allow trading on computers. And suddenly we begin to shift from this sort of, these guys, and they're mostly guys, sort of buying and selling stuff in an actual exchange to more computer trading. 1987 is one of the famous, more recent stock market crashes. 2000, the dot-com bubble burst, and there's some crashes there as well. There's a lot of good news along the way in between these, by the way. 2008, the most recent major crash before COVID, the housing market and some of the sort of securitization caused challenges lead to a huge loss of wealth in 2008. And then 2020, COVID ends the longest bull market in US history. Bull market, by the way, is a time without a 20% drop in investments. So when we think about the zooming out, it's very easy to get caught in the news about stock markets, but the sort of story overall is one of tremendous growth. And so this is the Dow Jones over time. And you can see the amount of growth, we're looking at, 11, 12x, more from the 90s to today. And so just huge, people that have savings and are putting it in savings, yes, there's ups and downs, but you're still growing a huge amount overall. The other thing that's happened is this growth, this 10x since 1990, and this short bear market, we're really at a moment of just incredible wealth being generated in the stock market. The S&P, which is one of these big indices, rose 52% from March to August 2020. And just an enormous level of climbing, an enormous amount of wealth creation in a very short time. So what's happening here? Well, you see all this wealth being created and other people want to participate. So if we were having this conversation 20 years ago, well, first, it probably wouldn't be on Zoom, but second, you'd actually have many fewer people invested in the stock market. But instead, what's happening is you have the stock market become more accessible than ever at a time when it's growing pretty considerably. So many of you know Charles Schwab, historically a big investment house. Well, they have an online version, and they gained 4 million new clients last year in terms of people that are newly investing in the stock market and buying individual stocks or mutual funds. Many of you have heard of Robinhood. It's in the news more recently for some around the sort of GameStop frenzy. But 10 million new brokerage accounts were opened in 2020, and more than half of those were with Robinhood. So suddenly you have this huge population that is participating and has access to stock in a way that might not have been true a long time ago. And so who owns stock? Well, 14% of families have a direct investment in individual stocks. These tend to be high net worth folks, high income, which we'll define here as over 100,000. In some parts of the country, we might not think of that as high income, but those folks still often own a large percentage of stocks. New millennial investors, so we're seeing a really big use of stocks and stock purchasing by millennials, which is a shift. And so in some cases, actually, these folks are buying stock instead of real estate, the way previous generations might have. And so that's a really big difference. More folks are renting later. And so a big chunk of that money is going into stocks instead of things like down payments. And then boomers across the board, even those that are not high net worth with appreciated assets. But overall, more than half of US households have some investment in the stock market. So just sort of overwhelming participation compared to literally any point in human history. And then we asked actually you, what's your level of participation? And so this is all obviously anonymous. But what you can see is that of the folks on this call or participating here, 8% of you own only individual stocks. 26% own only mutual funds or index funds. 44% own both. So really big participation. And then 21% said, no, I don't have any of these. So just an interesting dynamic here. I mean, you guys are educated, white collar workers. You know, many of you are probably not super high net worth, and yet you can still see the broad participation here overall. So now that we know a little bit about that, let's talk about why this matters to giving, and how does behavior change when people have stock and give stock compared to just giving cash. So before we get, the story of why stock is useful is really about why, what are taxes and how are stocks taxed compared to other types of tools. And so if we now understand stock, we need to understand capital gains, and then we can build on this to talk more about giving. So capital gain is an increase in the stock's value compared to what you paid for. Capital gains tax is usually 15 or 20% of gain when sold after being held for a year. So that's really important to know. There is a small number of folks for whom capital gains will be 0%. That is sufficient. Those people are sufficiently low income that they're unlikely to be major donors. I think it's about $44,000 per year in terms of total income, above which or below which you pay very little capital gains. It's pretty rare for people to have a lot of appreciated assets and have less than $44,000 in income. So I wouldn't worry about that, but I did want to note it for you. These are also often subject to state income tax. So in New York, where I live and pay taxes, if I have capital gains, I pay 15 or 20%, I think 15% because I don't have that much money, 15%. And then on top of that, I'll be paying about another 8+% in state taxes, and another 1-something% in New York City taxes. So suddenly we're looking at 25% taxes overall. And so why does this matter? Well, actually, when you give stock instead of cash, you actually save on 2 types of taxes at the same time. So we just talked about all those capital gains, right? Which could be up to 33% if you're giving from a place like California, up to 30% in New York. You actually avoid all of these, but also you receive a federal income tax deduction for the full present value of the stock. And in some places, but not all, which is important, some places, you receive a state income tax deduction as well. So really, really important stuff here. So you're basically layering double tax benefits onto the same time. So we take this guy, George from California, as an example, and he owns some Netflix stock. So he bought Netflix at 100, he sold it at 500, or he has it at 500. If he donates this instead of cashing it out, he saves $80 in federal income tax. He saves $53 in state income tax, and he gets a full deduction for giving that $500. So he saves another $185 in federal, and it may save an additional state income tax of $66. So we're just going to add all the math up for you. He gets $384 in tax savings for giving $500 away. The other way to think about that is it cost him $116. I think that math is correct. Someone can correct me if I'm wrong. $116 to have $500 of impact. And so you can imagine George sees this and says, wow, this is great. This is like all this sort of free donations I get. How can I do more and more of this? Just a quick reminder, we sometimes think about a lot of money in the stock market or having a lot of money in stocks as making it good for gifts. What's actually really important is having a lot of what we call appreciation or capital gains. So the biggest tax incentive around giving stock is having all this and not just having lots of stock. But there's about $10 trillion in capital gain in the US in the last few years alone that people will have to pay taxes on if they sell it. And so the way to eliminate these capital gains is actually to give it to you all, which is great news all around. The other reason this is really, really beneficial is when we look at the average size of a stock gift, and this is from you all, about 14,000. We see in some of our tools about 11,000. So we're talking serious 5 digits here. And the difference here is, you can all imagine what your average cash gift is. Let's call it $100, $200, $300. Maybe it's $50. And yet, these are often exactly the same people. So you're getting larger gifts from the same people, not larger gifts from this sort of other mystery group of people. The same folks that when they give you cash, they'll give you a lot less. And so anytime you're getting a cash gift from someone who could give you stock, you're probably losing out on a whole bunch of money. Average number of stock gifts per year, by the way, was 38 when we surveyed you all. And so why are these gifts so much larger? We already talked about the taxes, but a couple other reasons. One, it's where the money is. So 97% plus of wealth is held in non-cash assets. So it's really, really important to go where all the money is as opposed to just ask for the cash in someone's wallet. And the US stock market at this point is about 34 trillion, which is almost twice the US GDP. The other thing is that when you actually talk to someone about their investments or anything else, they feel wealthier and they donate a lot more. And if you reflect on your income instead of your wealth, you'll donate less. Just psychological anchoring effect. You know, when I think about, well, I have a couple $1,000s coming in a paycheck. Do I really want to give half of that away? I don't know. But we'll walk through an example here. So if our friend Rachel is from Texas, she makes $20,000 a month. She's pretty well to do, right? This is about a little under $250,000 a year. She has $500,000 in stocks and other investments. She's considering a gift of $10,000. This, in her mind, is half of her monthly income. That is an enormous sum, right? Giving away half of your monthly income feels like too much. But it's also 2% of all my investments. And that feels like something I can definitely afford. Same amount of money, the difference on the anchoring point will really trigger different levels of giving from someone like Rachel. Many of you know Russell James, and we've talked about this in the past, so I'll go through it quickly. But there was an analysis of 1 million nonprofit tax returns by Dr. Russell James that showed that organizations who look for cash donations grew by just 11% over a 5-year period. Organizations taking any non-cash assets grew by half, really good. And then organizations taking appreciated securities, and securities are just a fancy word for stocks and some other tools similar to that, grew by 66%, so 6 times faster. One thing I wanted to sort of name before we get off this topic is that yesterday, there's a big article in The Hill. The Hill is a big congressional newspaper for those of you that don't live in DC or don't sort of follow politics. And the Biden administration is looking at some tax changes. And they're thinking specifically, how do we raise money and more revenue, especially from folks making over $400,000? And one of the big opportunities here that the Biden administration sees is, what if we raised the capital gains tax, right? A lot of people are doing really well on investments compared to people that maybe aren't making that much on income and salaries. And so maybe it'll go to 25, 27%. Historically, it's been even higher at different points. Now, suddenly all that math, remember we walked through that California example, that gets even more egregious in terms of the level of savings. And so these tax changes wouldn't take effect until 2022. But if you want to use this year to get really good at stock giving, you can imagine it's going to take another leap forward in 2022 if this passes. And it is, it's a close Senate. It's not totally clear that it will pass, but it could. So just keeping an eye on that. All right. So now, what do we do? Actually, quick aside, Vanessa asks, do orgs have a minimum amount for accepting gifts of stock? The answer tends to be no, for 2 reasons. 1, it's not that hard to take. And 2, you really, really want people to give stock, because once they do, they tend to give repeatedly. And so those gifts will go up over time. All right, so how do we actually get stock gifts, right? It's really nice to sort of understand the theory, but what we really want is money that we can fund into our mission. So there's really 3 big avenues here. And the channels that we talk about are: 1, what is on your website, which turns out to be super, super important. 2, what do you do in one-to-one conversations with major donors? And 3, what do you do with emails and direct mail? And there's probably a 4th here around events, but a lot of events will break into what's on the event website. How do you have one-on-one conversations about big event ticket items? And then 3, how do we actually invite people to events? So for those of you that are very event focused, think about filtering that through these 3 avenues. Okay, so first, the website stuff actually tends to be super, super important, easy to get wrong, but also easy to correct. So I want to walk you through what that looks like. Why do we even have this on our website? 1, we want to give donors who already want to make a gift an easy path to do so. 2, we want to capture information of people who are interested, but may not complete a gift without a little bit of help or an extra nudge. And then 3, we want to provide education to people who are curious about stock giving, because those people might transition to much larger gifts than if they're just giving cash. So what does it look like? What we see here, and a lot of organizations are doing this increasingly, they're shifting to not just having the link to stock on their donate page, on their ways to give page, but also on their donate page. Because they know that when someone's ready to give, if they can get a gift of stock instead, that gift might be 10 or 15 or 20 times larger. And so that's really, really important. This is some recommended language, and we'll send the slides around afterwards so you can just copy and paste it. But what we've tested is we see many donors prefer to make gifts of appreciated stocks, bonds, mutual funds, et cetera, because it can have a large impact on our mission while maximizing potential tax benefits by avoiding paying tax on capital gains. If you'd like to transfer your appreciated assets, you can use our tool, and if you don't have a tool, you can, you can share some more resources there as well, or you can access transfer information and work directly with your broker to transfer stocks. And so a lot of people just say, give stock, whatever. You really want to have a couple of these signals here. And we'll talk through more of what they are in the one-on-one messaging, but around many donors prefer to do this. Here are a couple of different ways to do it. Here's why it matters. This is really, really important, and will generate a lot more gifts. And the nice thing about websites is all you have to do is get it right once, and then it's just there for the next 2 years. So you can put an hour of work in, and suddenly you're reaping benefits for you and your team for a while. The second thing is around transfer instructions. Now, many of you know what these are, but this is the information that a donor or a financial advisor needs in order to transfer stocks from their account to yours. You can't just use an address. This usually includes the name of your broker, the address, the account number, something called the DTC number. Most people don't know what that is, but it's a depository trust company number. And it's basically a number for wiring stocks. There's actually a company in New York called the Depository Trust Company that helps facilitate all of this. It's sort of quite archaic work, but important. So let's talk about what else you need to do on your website around transfer instructions. This is really, really important, and a lot of people get it wrong. So I'm going to go a little slower here because you can fix it, and then you can save yourself a bunch of headaches for the next 5 years. So about an hour of work will get you a lot better in a very short amount of time. So you don't want to, what you really want to do is collect the donor information before revealing your transfer instructions. This is really important. You will stop receiving stock gifts without donor information, which is a huge problem at a lot of organizations. Gift officers can follow up with people who've thought about it but haven't quite finished, so you can close a lot more donations and hit your goals. You'll also reduce the risk of fraud. We'll talk more about this in a second. And you'll have an end to delays, which increases gifts among younger donors in particular. So this is what it might look like at a high school called St. Ignatius. They just have a real button that says access transfer information. And in order to fill it out, in order to get that, you just need to fill out a couple of questions about what you're giving. That way, when that stock comes in, because it often comes in without a name attached, they know, okay, well, this was from Patrick, and it's very easy and accessible to thank him and build that relationship. Instead of getting mystery stock, which means I'm not getting thanked and I'm really upset because this might be the biggest gift I've ever made, and a bunch of other challenges for the organization. And then, fill this out, and then they just reveal the right info. So pretty straightforward, but really important. So what are the mistakes that people make around this? Well, sometimes a lot of people put the DTC or the transfer instructions site, but that is actually a mistake. So why does that happen? One, donors make a gift, but then the brokerage doesn't share information. So I made this gift and now I never hear back. And I'm probably not going to give again because I haven't been thanked or stewarded. Two, maybe I start to make a gift, but then I get distracted. I have a busy life and I don't finish, and then no one calls me. And so that gift is never getting made. And you lose out on potentially tens of thousands of dollars. You also may increase the risk of fraud. If you just have your DTC information publicly available, there are web crawlers and other things that are malicious that will start looking for DTC information on different websites. And it's not like someone can just use that to take the money out of your account, but it's very easy for someone to then call an employee at your organization and say, is this the owner of this account number, et cetera, and start to do some phishing that way. So it doesn't increase the risk of fraud, and we caution against that. But if you don't, by the way, there's a corollary here. If you don't make DTC information at all, you'll lose donors. So here's why this happens. Sometimes people say, listen, just email Martha, and Martha will get back to you with the right information. But Martha doesn't work 24/7, and she doesn't work nights and weekends, which if you have a job is probably when you're giving stuff. Many donors, especially millennials and Gen Z and Gen X, they don't want to talk to strangers about giving. And so the idea that you're going to have to go contact a stranger decreases giving as well. And so the solution here is just capture the information and then immediately reveal the information as we showed St. Ignatius did. So pretty clear. Jean asks, so an email with DTC information should not be automated. You're okay with that. It's not that people are sort of individually going through the site. It's more that you have these web crawlers, and I'm not sort of so sophisticated on this, but basically robots that are sort of trolling the web looking for bank account information, DTC information, et cetera. and gathering that up. It's not as though people are necessarily wandering from site to site impersonating donors. That doesn't happen in our experience. So great questions. Okay, 2, in one-to-one conversations, what do we do? Well, there are a couple goals of these conversations. One is that stock giving comes across as not a mystery. It's accessible, it's common, it's straightforward, and really we want to smooth this out and give someone confidence that they can actually do this. 2, your donor understands not only that they can, but why it's so important, why it's important for you, why it's important for them. And then 3, there's clear next steps, as opposed to thinking, oh, stock giving is good, I know exactly what to do next. So couple of tips here in your one-on-one conversation. This can be really, really powerful. So we use social proof. People really want to learn what people like them are doing. And this drives a lot of action, especially in what we call low information environments. So if you don't talk to other people about stock giving, you don't really know whether all of the people you know are doing it or not. And so you as a gift officer can play a really big role here in establishing a new social norm. It's also actually easier to deliver than some of the other things you might do. And so just say, hey, I'd love to teach you about something that other people are doing. Do you want to listen for 2 minutes? And people are usually very welcome to do that. Second thing, and we talked about this a bit in relation to other giving, this idea that you are an advisor and not necessarily a solicitor is really important. So the things you'll teach them about stock giving are true for any of their giving, to their church, to their alma mater, to the local land organization, even if it's not your organization, and they'll be really grateful there. So most of your donors are going to give to more than one cause. That's okay. That should be celebrated. And so when you can share some advice around any of your giving, I know there's a lot of organizations you support. Would you like to hear this about how you might be more savvy across the board? People really start to change the relationship with you. And this provides a lot more giving to your organization. And then obviously the more they start giving anywhere stocks, the more they'll give to you, and you'll be a lot better off. And then 3, we want to talk about what we think of as the perfect follow-up note. Because a lot of folks say, great, I have this conversation. What do I do now? The perfect follow-up note solidifies the relationship, it reiterates the opportunity, and it provides clear next steps. So let's walk through this in a moment. So here's what we think of as the perfect follow-up note. And again, we'll send this template to you after the fact so that you have it and you can actually just copy and paste it and try it with your own donors. So Rachel, I'm so glad we could make time for each other yesterday. And I actually want to point out in this, why is this sentence important? What it does is we made time for each other as opposed to you made time for me, right? We're not in this sort of powerful, low power relationship. We're working as equals because while you have money, I have the path to turn that money into impact through our organization. So we're doing this together and it's a partnership, not a supplicant relationship. Thank you for sharing more about your life as a new mom, your recent promotion, congratulations. And I'm glad I was able to give you a small window into the serious impact you are having at the Land Trust through your support of the Crestwood Lake Rehabilitation Project. Now, what we're doing here is not just sort of making you a supporter, but talking about the specific impact you had on a specific project. Again, you think of yourself as the vessel for them having impact, not them just being a general supporter of you and you begging. A paragraph on a gift agreement, if you need it. And then this next paragraph is really important. I also want to share that we're increasingly seeing supporters like you choosing to donate shares of stock instead of cash. Some folks are surprised to see how big the combined tax saving is between avoiding all capital gains and getting a full income tax deduction. So this idea that other people are doing it, other people are learning about it, really welcomes the donor into that idea of, okay, I'm ready to learn a little bit more. I share this in case it's helpful for any of your giving, so you can have more impact at lower cost to any of the important causes you support. Again, we're sort of coaching someone in all of their charitable giving instead of just to us. Our organization has this tool. You can link to resources or other things like that, which many people are using to make stock gifts, or simply learn more about the process and benefits, including what it means for donors in Maryland, right, where you might live. And so it's not just general language. Think about how do you help people learn about the impact in their state. Look forward to seeing you again, etc. So some interesting stuff there. And this is actually something you can actually just put into practice immediately. After you have the next conversation with the donor, either in person or on Zoom or over the phone, use this template, let us know how it goes. But we think that there's a lot here that will make your work a lot easier, especially if you can just double the impact of all of your one-to-one meetings, you'll be in really good shape. You're welcome, Michelle. Thanks for saying that. Quick aside, I know about half the folks on the call are FreeWill partners and half aren't. So if you're not, just excuse this PSA. but we are running 2 upcoming trainings on stock for all of your gift officers or anybody on your team. The whole sort of crew is welcome. March 29th, how do we think about tax season and stock gifts? And then April 7th, a little bit more on the integration into websites. So we'd love to see you there if you can make it. Okay, back to general stuff. In emails and direct mail, the strategy here is a little bit different than cash gifts. The role of these notes are to educate donors, not to show that you're going to get an immediate gift as soon as you send this out. But what you'll see is that you can educate and start planting the seed. And once donors make a stock gift once, they're likely to do so going forward. So a little education might be worth 100 times a single gift because each of these gifts gets so much larger. So the role of education here is really important, and it can be pretty straightforward. You don't have to be an accountant to do this. Tax season, by the way, is a time that is perfect for doing this. So we wanted to really make sure we got this this session done in mid-March so that you can think about in April and et cetera, how might we message this when it's really front of mind for folks. Here's an example from Amnesty International, great human rights organization. And what there, you can see this sort of first paragraph. As you sit down, I want to share 2 ways to save on taxes and support critical human rights work at less cost. And then we walk through stocks and IRA. So really smart from Amnesty to do this and very thoughtful about it, right? And it's not going to generate a ton of giving on day one, but now you're starting to get people in the mode of thinking, oh, next time I'm giving, I'm going to move to giving stocks, and those gifts end up being much larger. A couple other examples. This is from Bridging, which does a lot of great work and talks about how you can transfer assets directly to Bridging to make your work done easier. Another social media post, make taxes work for you, donate stocks and reduce your tax burden while supporting causes you love. So some really good language around the tax benefits, but also tying it to the overall impact and not just saying save on taxes. Save on taxes while doing the thing you most care about can be really, really valuable. Karen asks, why wouldn't people do this towards the end of year? End of year is also the really strong way to do it. But what you don't want to do is just wait 9 months and only do stock giving messaging once. More on the education front and really cool things we're seeing around the nonprofit web. What you can see is that on St. Ignatius' site, they can actually show you state by state what the maximum benefits might be. And so did you know that when California residents give stock, they can see tax savings of up to 74% or even more? And this would change based on where you are, if you're in Ohio or Texas or New York or whatever. The other big trend we're seeing, which is really interesting, and I'm looking forward to seeing where this goes in the next 5 years or so, is more and more nonprofits are using tools to help donors, what we call e-sign, which is an e-signature, and do stock transfers completely from their own website. So they don't actually have to go out and talk to their financial advisor or go do other things. This is a major trend. This process can be completed in about 5 minutes. So let's call it 3 times the length of a credit card donation, and results in dramatically higher gifts. Within 3 to 5 years, we expect this to be the norm across nonprofit sites. So the same way that at one point credit cards, were barely noticed on nonprofit websites and then became normal, and PayPal and some other tools, this sort of easy donations of stocks and other tools are going to move more and more in terms of the mainstream. And so you'll probably see this on your own site, on other folks that you support quite frequently. And so keep an eye on that. What does it mean for, not just cash giving, but what are called qualified charitable distributions? Just as a reminder, these gifts are tax-free gifts made out of an IRA account. They're the fastest growing area of philanthropy over the last 3 years. So there's a bunch of reasons why, tax changes, demographics, et cetera. We've talked a lot about this in other sessions, so I won't go into it too much now. The average gift here is $7,000. Again, from the same people that are gonna make much smaller cash donations otherwise. They can be given by anyone over 70 and a half. But when we asked you, okay, that sounds like a relatively small portion, but 43% of the prospects in most nonprofit marketing databases are over 70. So there's, and not just the percentage, but also those folks tend to be a little bit wealthier because they've been saving up for their whole lives. And so let's call it half to 60% of your donor capacity is over 70. And these are the fastest growing tools among that demographic. What we expect in 2021 is that these will see 70% growth or more. Why is that? Because 10,000 boomers become eligible every day. This sort of massive demographic wave means that there's just an enormous, literally millions of people turning 70 every year. There was no what we call required minimum distributions in 2020, which means these balances got larger, right? The government told older folks, look, you don't have to take any money out in 2020, but in 2021, we're going to start making you take it out again. And then the stock market, as we heard, grew 50% from March to August. And so the amount of cash in these things is just growing exponentially. But lastly, there's sort of this increased donor awareness. We're seeing more and more donors learn about these every year. And partly that's because you're doing such a good job. And there's a massive increase in nonprofit marketing this year. And actually in 2019, it dipped a little bit in 2020. But as more and more nonprofits anywhere are marketing this, those gifts are going to more and more nonprofits everywhere. And so really exciting. As a note, in 2016, this was the last time we could find out good numbers for it, there's $7 trillion in IRAs, and that might be up to $10 trillion now. So just an enormous amount of money in these retirement accounts, really looking for places to go. One thing, and I wanted to make a quick aside here, our friends at the American Heart Association are doing a ton of work right now, along with a lot of great nonprofits, to push forward new legislation. This would allow people from over 75 to do things like fund life income gifts, which is, tends to be charitable annuities and other things like that, from their IRAs, and they would increase the giving limits on QCDs from 100 to 130K or potentially even more. So nonprofits overall could see an increase of $1 billion in new giving. This is really, really important. So the Boy Scouts, AFP, ALS, Goodwill, YWCA, all these folks are really teaming up here. If you're not part of it, you can contact Emily Horowitz at heart.org. Here's her email address. But Jeff and Emily, Jeff Mueller from AHA, they're actually on the webinar. And so if you have any questions about this, they can sort of type in the chat and share anything as well. But, it's really nice to have folks in the field who are leading the charge for all of us to make some of this giving vehicles a lot better. So big thank you to Emily, Jeff, Pam, other folks at AHA, and all the other folks in the coalition partners. And if you want to get involved or you want to sign your organization up or even just call a couple of key members of Congress, there's a lot of really important work to do here. So thank you guys. And then my colleague Simone, who's on the call, has also put a ton of work, and as well as my colleague Magda, who may be here, doing our third report on QCDs. And so we're really looking at all the trends here. We shared a little bit of it, but it's about 26 pages of cool stuff in terms of figuring out where are these gifts going, what's the average size, what marketing works, et cetera. So if you like this report, just let us know and we'll send it over to you. All right, we are closing out with what it means for planned giving. So a lot of people don't think the stock market and planned giving have a lot to do with each other, but actually it almost couldn't be more false. So what you look here is that the IRA accounts and retirement accounts generally, this includes 401ks and Roth IRAs, are just growing enormously, right? You can look at the average IRA balance here, and in 2020, it's $130,000. And it means that there are some folks with much, much larger balances here. The number of retirement accounts, the number, not just the average, has grown by 10.5% since late 2019. And so huge sums of money here. What it means is that the importance of what we call beneficiary designations, and those of you in planned giving know this really well, but some of you don't. Beneficiary designation is usually passes outside the probate process. And it's just that little thing that you fill out when you go to work and you set up your 401k and says, okay, well, who gets this if I pass away? And you might have sort of added your sister or your spouse or someone quite quickly, but as you get older, you really need to think about this stuff because it's not affected by your will. And over the next 2 decades, potentially $30 trillion in wealth is getting passed from the boomers. A lot of this is going to be in IRA and stocks, right? And the IRAs are really important because your heirs are going to pay taxes on that no matter how big they are and no matter whether or not you're above the estate tax threshold. And so a big IRA, especially in a higher tax state, can get taxed at more than 40%. Which makes this one of the ideal planned gifts to make and a really easy conversation to have if you're a planned giving officer. And so we think that along with bequests, these are going to be the dominant form of planned giving over the next 10 years and just enormously important for us as a sector to get really, really good at. Because donors are still sort of confused about this and frankly, so are many gift officers. And so, a small tip here is that when you get a qualified charitable distribution, remember to ask about whether someone wants to learn more about beneficiary designations. Now, once people are thinking about the IRAs as a giving vehicle, it's a huge opportunity. And if you're getting a QCD, you might be getting 1 or 2% of that whole IRA. So just multiply that by 100 and get a sense of how much money that might be. FreeWill actually is doing a ton of investment in research here and resourcing. And so we built out a new tool to educate folks around beneficiary gifts. This is launching in the spring or so because it's so important. And I sort of share that because I'm really excited about it, and a bunch of designers and engineers and experts have put a ton of work into it. but also just as sort of a proxy for you to understand where we think the world is going and what we think is going to be super important for the next 5 years or so. And just to sort of reiterate that, I think that beneficiary designations and getting really good at them are going to be key. One of the key differences between success and failure, particularly at plan giving organizations, but frankly, plan giving is going to be one of the differences for success between success and failure at many organizations over the next decade. So if you're thinking about where should I get smart, where should my team get smart, beneficiary designations are a huge part of it. A very quick thing on Bitcoin, and then we're going to wrap up. So Bitcoin is exploding. It's about $60,000 a Bitcoin right now. It's part of what we call cryptocurrency or digital currency. There's a bunch of different kinds, and Bitcoin is often used synonymously, but there are frankly a lot of different tokens or currencies in this context. It's subject to capital gains the same way that stocks and mutual funds are. So, it's newer, so a lot of gift officers don't have a lot of experience here, but they're exploding in popularity, and 1 in 3 Americans say they'll buy Bitcoin in the next 5 years, which is just a pretty remarkable stat. Total value of all cryptocurrencies is about 1.6 trillion. 970 of that is Bitcoin. So you can see the divide there. We'll cover more of this in a future session. So I can't really spend an hour going into Bitcoin right now, but you can just think of this as like another type of stock. If you can get good at stock giving, you'll easily be able to transfer some of this into Bitcoin and cryptocurrency. And this will be really, really valuable for folks to get good at going forward. Okay, a couple of resources. We're going to give away these books. Just make a note in the survey. My colleague Simone is just dropped a note to the survey in the chat, so please take a minute to fill it out. We also put together these resources that we shared, but both the report on qualified charitable distributions and that email template we walked through of the perfect way to follow up after a one-on-one conversation. We're doing my colleagues Alyssa and David, who are just wonderful, they're doing a walkthrough of some of these tools on Thursday in case anyone wants to join. I won't be there, but you'll be in excellent, excellent hands. And then if you want a one-on-one demo of a stock tool or the request tool or the new beneficiary tool, which is really cool, or around QCDs, just make a note of that in the survey too. And one of these amazing people will talk to you about it. So that is cool. So we're going to take a 60-second break. I'm going to look at all the questions. Please fill out the survey, and we'll come back and do questions in about 45, 60 seconds. And I'll just prioritize them among what's been asked the most. Great. Okay. Really good questions here. So I will sort of take down screen sharing. Quick note is that next Tuesday we're doing a big session on diversity, equity, inclusion, and some really effective management tools. And our friend Melanie, who is a sort of very well-renowned diversity expert, will join. And so she'll actually be doing the bulk of the training. And I would highly recommend that. I'll be here to sort of intro and facilitate questions, but she's excellent. So I'm going to pause screen sharing and talk through some of these questions. Elizabeth asks, is there an especially good time of year to ask for a stock gift? And yes, the answer is year-end. Year-end is a really, really good time. A lot of the sort of structured giving is happening then. 2 is around tax time, which we're talking about right now. And then 3, and this is really important, is how do you generally bake it into the times that you're asking anyway? So if you're asking for money, you should think, well, let me not just ask for small gifts at this moment. If someone's ready to give, let's make sure they're giving in the largest possible way and the way that's sort of kindest and most effective for them. So you can think about a couple of moments to really focus on education around stock giving, but also how do you drift it into all of your work across the year? Does the tax, this is a question from Betsy, When we talked through that example of George in California, does it assume that George is itemizing his deductions? Yes. So in that case, it does. Although if he's not, he'll still see much larger tax savings from donating stock than from donating cash anyway. Question says, donors can only donate appreciated stock. Is that correct? That is generally correct. You don't want to donate stock that is depreciated. The answer is a little bit confusing, but basically you can save on taxes by selling it and then donating the cash, because those losses will offset gains that you'll get somewhere else at some point. Great question. Marcus asks, are financial advisors open to sharing information about nonprofits? The answer is yes, but it's not their main job and they're very busy. So one tip that we give to folks is, if you have 3 or 4 non-financial advisors that you want to share stuff, especially if you're in your region, right? If you're a local organization, one opportunity is go to them and say, hey, we sometimes get people asking us for recommendations. Is it okay if we provide your name as on this list? And if they say yes, they'll usually say yes, because financial advisors are always looking for new clients. You can say, great, well, if anyone's ever looking, and then you can follow up, having already done something kind for them, if anyone's ever looking to support animals, here's some information about our organization. So you can use that tool. A lot of people just sort of send stuff out to financial advisors and they're overwhelmed. If you're a financial advisor, you're getting pitched on all sorts of services from all sorts of people that are not charities, and it just ends up collecting a little bit too much. Can stock gifts be received by organizations that are not 501c3 nonprofits? Yes. So particularly something like a 501c4 that doesn't pay capital gains taxes, but is not eligible for tax deductible donations, you can donate stock. You won't get a tax deduction, but you will avoid capital gains. So there's still some benefit there. And if you're a 501c4 organization, you may want to think about this as a way to get larger gifts. Would you guess that more potential donors own stock or have donor advised funds? Would you think there'd be some overlap between the two groups? Lauren, great question. It is likely that more people own stock. Donor advised funds are still large, but a much, much smaller percentage than stock ownership. And this is really important, the biggest amount of stuff going into donor advised funds is appreciated stock. And so if you as an organization get better at taking stock, that money goes right to you instead of through a donor advised fund, and then maybe to you later. And so the national DAFs in particular, the Fidelities, the Schwabs, the Vanguards, have gotten so good at taking stock that some donors will just want to give it there instead of giving it to you. And your job is to make it really easy for you to take stock as well. So it's a great, great question. Serena, does information apply even to Canadian residents? Yes, there's a lot of similarities between Canadian capital gains law and tax deductibility as the US. I don't have perfect information on it. And the tax rates and the calculations that I gave are not one-to-one. So you have to do your own calculations, but the first principles still apply. Great. Abraham asks, how long does the transfer take when it comes to ownership? Also, cost factor for the receiving organization. So Abraham, what most folks will have is a broker set up to immediately sell the stock once you receive it. That broker sometimes takes some very small transaction fees. It's usually sub 1%. So it's much cheaper than taking credit cards. It's in some cases even less than 0.1%. So some folks, if they know their own prices offhand, can chime in, but that's that. Okay, it's 12:56 on the East Coast. Let's pause there so everyone gets a break before their 1 o'clock meetings. But just want to say a really big thank you, both for spending an hour together. I know you guys have really busy lives outside of having really busy work lives too. And two, just thanks for pushing yourself a little bit to learn more and figure out how you can do more things for the organizations you serve. It's always one of the best parts about this hour for me is the sort of first 5 minutes before we're on and people are introducing themselves about exactly what they did and what organizations they're coming from. And the range of just amazing goodness on this call is pretty great. So huge thank you. Hope to see you next week. But generally, if we can be at all helpful, let me know. And it's just nice to see you again. And thanks so much for joining.